Good morning, and happy Monday. Julian Williams here. Welcome back. I get the pleasure of speaking and hosting Global Trader experts Boris and Kathy. How are we doing this morning, guys?
It's been a really busy morning, as usual. I feel like this is the theme of every time we talk, but we kicked off, in one of the hottest periods of the financial markets, for better or worse. And it's just been, day after day, weekend after weekend of big news.
Right. Yeah. As I posted, it may be a tough time for investing, but it's a great time for trading,
There you go. Well, that's good. That's good news for those who are, kind of getting ready to tune into the stream here. How's the weather over there, Boris?
Eve, every time we talk,
it's a little chilly. It's near as nice as it is by you.
I guess.
Actually, yesterday went down to like the 20s. It's funny because I was talking to my friends in Australia yesterday, to my programs in Australia, and he's like, "Oh, we're having a heat wave. It's like 37 degrees centigrade, which is like 98, 99 Fahrenheit." And I'm like, we have the exact opposite. It's 20 Fahrenheit here. It's freezing. So, yeah.
It's actually kind of really neurotic because I remember on Saturday morning I went for a morning run and I barely even needed just like a sweater, like a light sweater, just regular outfit. And then yesterday it was freezing. I needed my winter jacket, and so it's just been completely neurotic.
Me too. I was having a great day Saturday. Then I walked the dogs like at 3 a.m, and I'm like, oh my god, I'm so underdressed. Yeah. So I guess the weather is just like the market, very volatile.
There you go. Yeah. What are you drinking on there, Boris? You got a little espresso shot?
I have my third or probably fourth espresso today. So there you go. Breakfast of champions. This is like all my kids always make fun of it because basically I live on seltzer water and espresso. That's my two drinks of choice. But yeah,
everybody take notes.
That's what fuels championship trading.
That's good.
Exactly.
Well, guys.
So your coffee guy makes espresso, Boris?
Sorry,
your coffee cart guy makes espresso.
No. I have my own espresso. I have an espresso maker, Kay. I've upgraded my life. I actually have an espresso maker. I hesitate to tell you how many of those pellets I go through a day because you will be just horrified. But yeah.
Gotta keep going. Now, Kathy, do you do a similar thing because you're up, sometimes different, late, night or whatever, what I'm saying, checking out the different, like you said, market open, time frames. Are you a coffee drinker or do you just,
Well, I mean, Boris and I are.
I go to lunch with her. I can't ever have an espresso at lunch. She's like, "Oh, I have an espresso at lunch. I'm going to stay up all night long." It's very exact opposite.
We're polar opposites. I'm a one coffee a day girl, but I have a giant cup of coffee. I do French press every morning. I grind my beans. I wait for it to sit, and then I press it. And so it's a whole process that I do every morning. But I love it. I mean, it makes the best coffee. I would never be caught. I mean, it's really snobbish of me, but I've never caught dead drinking a coffee cart coffee. I have a specific brand that I like, Counterculture, and I only get that. I don't care that it's expensive, and I make it the way I like.
Keeps you going. That's all that matters,
Exactly. As opposed to me, who'll just drink whatever they give me anyway, anyhow, That's it.
Well, guys, let's go ahead and jump into it a little bit. I know that's what the viewers are looking for. This past week was very volatile, like you said. Similar to the weather here. But are we going to get a little bit more, slow and steady? What are we looking at here?
I don't think so. I mean, we got a huge event week coming up. I mean, I'll let Kate speak to the events because there's just so much on the platter this week. Right. Why don't you review with everybody all the central bank activity that we have this week, including the big one.
It's central bank week. So, with central bank week, we rarely have consolidation. It's the prime market for breakouts, although everything's already kind of breaking out. But, this is a week where we've got, the Fed, the U.S. Central Bank meeting, and not only the Fed, but the Bank of England and the Swiss National Bank. And the problem is that, there's no real consensus on what these central banks will do. The market has a good guess, but with these central bank announcements, it's not just, the actual tweak they make to the interest rate. It's about what they say about what they plan to do going forward, right? The guidance. And so that's where the market really, is doesn't really have a good doesn't have the finger on the right pulse, and I think that is what will cause a significant rise in volatility, and that's what we're worried about because we talked about this on Friday. The Fed is 2 weeks ago, less than 2 weeks ago, we're looking at a 70% chance of a 50 basis point rate hike. Now, that's gone to zero. And we're only looking at, about a 60% chance of a quarter point hike and then a 40% chance of nothing at all. The BOE is 50-50 on nothing as well. And the Swiss National Bank has gone from 100 basis points to like 50. So, expectations have moved significantly in a very short period of time. And if the market doesn't, if the central banks don't deliver what the market anticipate, that could just mean more volatility. So absolutely not. I don't think that this is a week where volatility is going to subside. Hopefully with central bank actions, it will subside, but it's not going to be this week.
Okay. All right.
I think, so much of it depends on the banking issues. In other words, can the primary thing of central banks right now is can they stabilize investor sentiment towards the banking sector? So First Republic Corporation, which has been kind of the poster child right now for big risk, is down 18% this morning, right? So the Credit Suisse deal with UBS over the weekend was supposed to calm nerves, but UBS is actually down like $2 on the open. Investors, even though they bought Credit Suisse. This is a great point somebody made on Twitter. Credit Suisse got bought for half the price of Crocs shoes. Okay, if you think about that, and Credit Suisse is not, it's not a small company. It's got $567 billion of assets on their books. It's a big Swiss bank. So, despite all that, it's really a matter of stabilizing investor sentiment. Can the central banks kind of just calm the waters? Because if they can't, they have to forcibly respond with more and more infusion of cash or infusion of credit. And that obviously, completely takes them off the path of tightening monetary policy. So a lot of this stuff is kind of very, what's that word George Soros used to, reflexivity, very reflexive. It's what the market does, the central banks do, the market does, everybody's kind of tap dancing around each other. So we're keeping an eye on that very carefully, obviously.
It's almost ironic because I remember when I started off in the business in '99, the two creme de la creme banks to work for was Bear Stearns and Credit Suisse. Like those were the ones that you wanted to work for. Whereas JP Morgan Chase Citibank was like the blue collar bank that, the graduates didn't really want to work at. And you really wanted to work for the ones that went kaput right now.
Right. Exactly. Yeah, it's very funny. I mean, reputation, like everything else in the market, changes, Absolutely. I remember when people would tell me that, you want to invest in the Swiss bank because they've been around for 600 years. These banks never fail. And I'm like, yeah, everything fails eventually.
Exactly.
It's actually, by the way, it's the same sort of idea. If you think Apple will be around forever, that's not a given. I mean, Apple was on the edge of bankruptcy just 20 years ago. It doesn't mean that 20 years forward it may not be the same way. It sounds sacrilegious right now, but it's not impossible to conceive because everything in the markets changes. I think the only thing that stays constant in the markets is they all change. Everything changes.
Right.
Yeah.
Now, kind of moving forward on the topic of saving some of these guys, dodging a bullet, so to speak. I see some articles here and there, some about Buffett talking to the regional banks. Talk a little bit about that.
Yes, so that's interesting. Nobody really knows what's going on. Obviously, Buffett always is the go-to guy when it comes to rescuing everybody on very, very favorable terms to himself. There were reports over the weekend that there was a whole bunch of private airplanes that were parked in Omaha, Nebraska, meaning regional bank presidents were flying to Omaha to go see Buffett to seek capital infusion. Because it's clear, I think Kathy can speak to this because she did a little bit of more work on it. It's clear that this problem is not isolated to Silicon Valley Bank. There were a lot of banks that did not hedge their books and got caught very badly in this vortex of higher rates. So they're carrying a huge amount of mark-to-the-market losses, which they're not recognizing because they're keeping it in what's called the mark to maturity accounts. But if they were to actually kind of do a real, the way traders are, if the way our trading accounts are marked to the second. If we were to mark their accounts to the second, a lot of them I think would be sitting on a margin call. So that's why they're seeing Warren Buffett. Am I right, Kate?
I mean, for those of you that have been watching since we've been talking from day one, a couple of weeks, we've been talking about the risk in regional banks and how there's, always more underlying issues. Last week, we talked about how, during the 2008 financial crisis, the big names were lost, Lehman Brothers, Bear Stearns, Washington Mutual. But, there were 300 smaller banks that was lost from 2008 to 2010. And I think if you span that to 2008 to 2012, like over 450 smaller banks were lost. And that's really the concern here, because a lot of Americans have their money at regional banks because I don't know why, but they don't necessarily trust the big names or the institution, and they want to have at their local bank that they could walk into and talk to someone that they know. So I think that is where our biggest concern is. That's where the central bank's biggest concern is. And all of this whole banking crisis that we're seeing is what is going to bring down inflation. All of this is disinflationary. And inflation has been the biggest concern for all of these central banks, and they're worried that despite the steps that they're taking, inflation is sticky and it's not going to come lower. But this is, for better or worse, and definitely for worse, what is going to put inflation on a downtrend from here on forward. And that's where we really have to tune into, because we're in a shift in the cycle right now where people are not going to think about how much more inflation is going to rise. They're going to start shifting their mindset to how fast inflation can fall. So, we've got the Fed's going to talk about it this week. We have the UK inflation data, which is right before the Bank of England meeting. So there's a lot. The next few months of inflation reports are going to be even more important because it's going to show the consequences of everything that's happening right now.
Kay, why do you think it will be disinflationary? Why does a credit event create a disinflationary shock to the system?
Well, what ends up happening is that it causes a shock to growth, and it causes shock of free capital. And so what that will end up doing is, I think a lot of, from a business perspective as well as on a consumer's perspective, you're going to see less of an inclination to keep prices high. And then, of course, the easy thing to point to is commodity prices, right? I mean, oil prices are down significantly right now. They're at $66 a barrel. And so all of that is going to filter down.
I keep saying, over and over again, I've never seen a whole bunch of experts be more wrong than oil guys who were all screaming $200 a barrel oil a year ago. And if I told you post-pandemic when we were like at $5 a gallon and, Russia was invading Ukraine and there was no oil anywhere in the world and gas was at like $300, dollars per square foot or whatever they measured in. If I said to you, oil is going to be at 65 in a year, I would have been laughed out of the room, but that was the trade. It's amazing how that's definitely had a big impact. And I think it's also true across other commodity factors, which is lumber and other stuff. The big question is, I think, corn, wheat, the consumables, the softs, if those go down in prices, then it's really hard to imagine inflation going up. One other thing on inflation I'll add, there was a really interesting tweet. And I know, it's a caveat, but I think it's an important one. If you take out owner's equivalent rent, which is the primary housing component in government inflation data, the actual month-over-month gains in inflation are zero. So literally almost all the inflationary pressures are coming from owner's equivalent rent, which is a very controversial figure because it is like a moving average. It's really, really, really long-term series. So it's basically catching a huge amount of rises from 21 still in 22. And as you see already, although Kathy will argue with me differently, New York City is really an exception to the rule. But everywhere else in the country, rents are actually going down. The housing prices are stabilizing and moving downward. So you can't really make a strong argument that we're having. I mean, I hear these guys go, inflation is going to be 8% forever. I'm like, where? even eggs are down to like $3 a carton or whatever. So not the only real sticky part of it is housing. And I'm not dismissing housing. Housing is still a very, very big problem in this country because we don't have enough housing. But even that is starting to really come down, except as Kathy tells me, in the suburbs of Long Island, where there's still 50 people showing up for every showing, right?
It's true. One of my friends had an open house next door. He said for 3 hours straight, there was 15 people online, waiting for, what did not look like a very attractive house. And so it's just a lack of inventory. And it's not, maybe it's just the Northeast. I mean, Julian, you can tell us whether Florida's like that or not. Whether it's still hot, but for us, I am not seeing the cool down. And with interest rates now falling or moving the opposite direction, which, because the yields are going to filter down to the overall interest rate, I think it's only going to stay frothy.
Yeah. Interesting. Yeah.
Well, I mean, you're talking about the commodities there, Boris and Kathy. How about the Bitcoins of the world? How about gold? Obviously, we're seeing that thing creep up, a little bit there. Right? Is it long term, or is it again? You think it's going to kind of hit that ceiling around 2000?
Well, I don't know. Why don't you talk about it? Let me see if I can pull up my tweet. I actually put a picture of Moby Dick on the on my gold chart, because I was basically arguing that if you look at the very, very long-term gold chart, let me just see if I can pull it up. Give me just one sec.
Look, I mean, you're a fool if you think that Bitcoin is a proper asset for diversification. But with that said, Bitcoin we looked at last week has a very strong correlation with US 30. And so, stocks are performing better. They're rebounding. So Bitcoin is down a little bit, but really not all that much. It's, holding its recent gains. So I think, your view on stocks should be your view on Biddy. If you think that the Fed will be more conservative, they'll do either zero, which would be great for stocks and great for Bitcoin. Then, stay in. If you think they're going to do 25 and still keep, their foot on the pedal, then you shouldn't be in it. What's really interesting is that, the ECB is living in the same world, right? And last week they raised interest rates by 50 basis points, and they're seeing the whole situation. They're watching the banking crisis. They're seeing their own bank shares fall. And yet, ever since Thursday, they've been coming out and just talking up, everything. Saying wage pressures are hot. We still need to raise interest rates. Inflation is still too high. So, it leads you to wonder whether the Fed's going to feel the same way, which is, there's acknowledgement of what's happening in the markets, but there's also recognition that that inflation is just way too high. So that, is really going to change things around when Powell speaks.
So I found my Moby Dick chart. Maybe I'm going to try to present it right now. So let me see if I can find it. Share screen. See if I can find the right settings. Here's the gold. Yeah, here we go. So I know it's very, very stretched, but so this is the monthly chart of gold, right? It goes all the way down to 2004, and I was using my literary license here. Moby Dick, which was obviously the whale that they could never find, they could never beat. The 2000 to me is like the Moby Dick line for gold. They've tested it over the last decade, over the last century, actually, 2 or 3 times, and we failed. We failed to hold it. So to me, the critical test of whether gold is a buy or not is if we can close above 2000, ideally around 2100, and hold it on a monthly basis. In other words, if at the end of this month, we're above 2100 on a closing basis, I think that's a very bullish technical signal, because what that means is that we'll clear all of this resistance, multi-year resistance. It will also signal what Kathy may be talking about, that inflation is persistent. I was thinking about, if you look back at the last massive rally in gold in the 70s, right? We had huge inflation in the early 70s, and gold did not really respond. It responded a little bit, but that didn't really respond, right? Then we had a period of calm, and then we had a second wave of inflation in the middle to late 70s, and that's when gold went parabolic. And I think that's sort of like the pattern that we may be seeing. If we do have that second inflationary cycle, that's when gold is going to go parabolic. And the charts will tell us. So I'm watching that very carefully right now. This is the in the near term, it's the 2100 line that needs to be taken out for me to be convinced that this is a buy. For now, it could just be another broken heart for everybody who is looking to get long.
Julian, last Friday we talked about trading strategies. And I just want to point out, last Friday we were trading, I think, around 1970 in gold. And we talked about how, a lot of these big assets love to gravitate towards round numbers. And we said, I said that 2000 was a given. It's definitely going to test 2000. Now, whether or not it holds that is a totally different story. Right. But this is the same kind of perspective that, our viewers should be taking when you trade anything, especially, the Dow, the Bitcoin, 30,000. I think it's going to test it. And so even though that sliver, of price action is opportunity, because we're traders, we're not investors. So, that is an opportunity that you can capitalize on without necessarily having a view on whether it's going to really, hold that break or not. Because like Boris said, it's a Moby Dick level. It may not, it's going to take a while for it to decide whether or not it wants to break above it. But between now and there, especially when we're moving to that level for the very first time in a while, that gravitation is an opportunity that we trade all the time.
So can you, maybe I'll explain why. So why was Kathy so spot on Friday saying, hey, we're close to 2000 is going to magnetize. Remember we're talking about magnetize, magnify, amplify. The reason why is because round numbers is where many, many, many traders put their stops at, right? So if you're short gold, you want to be short at 2000 because obviously, oh my God, if it goes 2000, that's a key level. People are very, very comfortable with round numbers, both on the stop side and the long side. So if you're close to that level and you're a dealer, right? What's your number? It's like easy. It's free money. There's going to be a ton of stops. I'm going to run it there, grab all the stops, bring it right back down. Because as a trading mechanism, it's an easy mechanism. Now that's something we used to observe all the time in FX. It's a trick that people would do at every handle. 134 yen, 135 yen, 136 yen, 107 euro, 108 euro. This is for 10 pips, 12 pips. We used to watch that. But it works the exact same thing in gold. It's just another instrument where people know, especially in a very, very big, this is a triple round number. It's just too tempting to not want to try to scoop it up. And then generally, you're going to get that sell-off. So the smart trade is, trade to that number, but get out as soon as you get there because it's going to retrace on you, usually on the first try. Rarely do they just...
I mean, it's a legitimate strategy. It's a strategy that the big guys at the institutions use. And it's an easy one for the rest of us, to follow as well. And, we just want to throw it out there so people are aware of this. We'll talk about this, all the time.
Yeah, exactly. While you have my charts on screen, let me just pull up Bitcoin because it's worth a look here. So, okay, this is obviously monthly, so it's very, very stretched. But the thing to me that's interesting on Bitcoin is, I mean, God, as much as I hate this asset, you got to respect it technically. Look at this, higher lows.
Can you zoom in?
Let me see. Yeah, let me zoom in. This is. I know. I'm like.
There we go.
But you can see. Oh yeah, now I'm looking at my own chart. And I'm looking on the screen. I can see what you guys. He's like, okay, yeah, I know my screen is really stretched. But it's higher lows. You got to respect this move. We held effectively the 1617, and if you're looking at the monthlies, this is uber bullish to me. This is uber bullish. Not to mention the fact that even on the monthlies, it's in my green zone. We've been in the red zone since May of 22. This is almost a year. We've been in the red zone for almost a year. This is the first. If we close here, that's a powerful signal to the upside. Much as I hate to.
Can you draw a horizontal line at 30,000 and show them where that there?
Yeah, I'll pull it up. Just one sec. So 30,000 would be right here, basically right over here, close. Okay.
So we're there's really no resistance from here to there, because we always talk about swing hellos, swing highs are really important levels, and you can see there's no resistance from here to the swing low from the middle of that chart that you see with the three spike lows right around 30,000. So it's going to want to test that, in my opinion.
Right.
And if the Fed does less, that could be the ripe environment for that to happen.
Yeah, and the other thing that's interesting is this is something both Kathy and I are very short-term traders, and nobody's a shorter-term trader than me because I'm basically trading the 1-minute chart all day long. But what's really valuable when you're looking at, some ideas is to go the exact opposite. This is a 1-month chart. This is as far, as wide a view as you can possibly get, because then you get to see the really big forces in play, and it helps you put yourself on the right side of the market. Like right now, there is no doubt you have to be on the buy side of the market. You have to buy every dip and you have to buy every breakout until proven otherwise, because that's where the odds are. The odds right now are to the long side in Bitcoin. So we'll see how it plays out over the next, even to the end of this month. But for now, all the path of least resistance is towards 30.
Now, Boris, on that topic, for the inexperienced traders out there, or for those who are just kind of getting started, might be kind of, piggybacking off of what you had said. You are obviously on the 1 minute, 5 minute, you've seen it, well, but do you think that there's traders that get a little bit caught up in looking at that, don't look at the overall move or do top down analysis? They don't look at the month.
100%. A good example of this is let's look at the futures. Oh, this is like, sorry, you know what? I can't, let's do the Dow because I can't use the S&P. No, actually, let me see if I can find the S&P. Hang on a second. I want to pull up the S&P CFD because I can't get. Oh, here it is. Here's the S&P CFD. Okay, here's the S&P CFD. Right. So this is the monthly chart, right? And this is a good example where what my argument on the S&P, and we can even go like a little bit lower, like say on a weekly chart. What you see on the S&P is just basically range-based trading, right? We're sort of like at 38 to 4,000. If you look at this, on a kind of a near-term basis, right? So there really isn't much to do. There's no trend here. We haven't really had trend in equities for a good year. It's all been just kind of range bound. We broke range, came right back into it. Broke range, came back, and now we're just range bound. And so when you look at these longer-term charts, it really helps you understand. Like this is why Kathy's been saying, take your profits and go. This is not an environment where you're going to be able to milk it for super 100 points worth of trades. If you're in a range-based environment, you got to just scalp it out, come back out, scalp it out. There's no trend here that's truly tradable. There's no one side of the market. It's basically up and down, and you got to try to position yourself, at the edges of that range until that range is broken. And what looking at the longer-term charts really helps you put yourself into context, where the context is. That's why people ask me, where do you think the market goes? I'm like, it doesn't matter because the market hasn't shown us where it wants to go. The market is basically twiddling its thumbs. And it makes sense because there's a lot of uncertainty. We don't have any economic direction. We don't have any monetary direction. We don't have any fiscal direction. We don't even have any geopolitical direction. Latest news out of on the geopolitics is that Putin all of a sudden decided he wants to negotiate with Ukraine. We take it with a barrel of salt, but the point is, there just seems to be lots of cauldron going on here. We don't have any directional views that are clear.
But I think on Friday it could be different. I think a lot could happen between now and then, and we've got this whole Putin issue could show more clarity. Central banks should show more clarity, and so we could have a very different conversation on Friday.
Right.
Yeah. No. Absolutely. And it's worthwhile. And it's very much worthwhile looking at these levels. We're only 100 points away from 4,000. Let's just, for argument's sake, let's say, he comes out and he's basically surprisingly dovish. Like he doesn't come out and say, I'm going to keep rates at 25, but beware, I'm going to raise it to 50 as soon as this banking crisis goes off. He says, we're going to really keep an open eye. We think the economy, the financial sector needs a little bit of rest. We don't see the inflationary pressures nearly as much as we used to. Any kind of dovish commentary, this thing soars. We as they say in the crypto land, it moons, right?
Yeah.
We'll have to see. Kay is absolutely right. We'll have to see what the reactions are.
Now, when it's a trending market, are you, obviously you're scalping, you're in and out, like you said, do you have like a point? I'm doubling my points that I'm going for when I am in a trending market, for, like I said, for the viewers, they're like, okay, you're scalping. If you're in a rangy, consolidating, it's balance and just ping pong. And if you have a trend,
in a trending market, the much more intelligent strategy is to always trade with the overall trend. In other words, So if you're trading with an overall trend, that means you want to be buying let's say it's an uptrend. In that case, you want to be buying the breakouts, or at the very minimum, you want to be buying every retrace. Like every retrace, one of the reasons why we're so successful and we're doing so well, I am like 3% away from hitting the 10% target with everybody in my group, right? In one account, and 1.5% away in my swing account of hitting.
And how long, Boris?
So on the scalp account, it's like the beginning of this month, right? Like beginning of this month. So that means it's like we are very, very close. The swing took a lot longer. Absolutely. It takes longer. But the great thing about Surge is, of course, there's no time limits. But what we're trying to do, and what I'm working on very, very hard, that's why I want everybody in my room, is we're working on a plan where we have a very realistic possibility of trying to get 10% within 10 to 20 days in a very measured, risk-controlled, efficient manner, like very selective. We have certain amount of things. But what I was going to say is the reason why we do that is we will trade to the trend of the day, right? That's the best trade is buying retraces in an uptrend, selling rallies in a downtrend. That's the best trade of the day. Now, of course, there are some days that are just, whipsaw days, and you're going to get roller coastered out. That's the risk. But if you trade properly, those are the exceptions, not the rules. The rules is to always be on the side of the flow. That's the way Kathy trades too. And, she looks at the technicals, and then she looks at the fundamental reason that she can enter. Like, in other words, if something is technically very, very strong, and she has a fundamental reason to believe that that's valid, she will go full on.
So the way I trade differently in a nice trending market is that I let the trade run more. In a market like this, we talked about how we do in and out, because you never know. I mean, this morning we were down, the futures were down. Now we're up a lot in the equity market. So things are shifting constantly. Whereas in a nice trending market, I'm able to let my trades flow longer, and I don't need to get in and out as quickly because there's less news bomb risk.
So as we're talking, I'm just looking at my chat room. One of the guys that I trade with said I'm just going to read it to him. He says, killed it this morning with BK bounce, 125 MES points. That's S&P points. That's equivalent to 1,250 US 30 points. Not a bad day. Only took 2 losses. Thank you for the amazing tool, BK, Boris, Kathleen. Namaste. But that is huge. The guy basically banked 1,200 points today. Doing what we're focusing on doing, which is being on the right side of the move. So come in. I mean, this is what we do. Yeah. The main thing, I guess, that we have this week is obviously the Fed, the BOE, and I think until that point, probably things are going to be very, very choppy. But what I was going to talk about, I think is really, really important, and Kate, I really want Kate to talk about this too, is the day of the Fed. Like my friend Anthony Crudeli, who's an old-time S&P trader, posted over the weekend. He said, during Fed days, I would always take my cues from the old guys who would never trade before the Fed announcement. They would come in and literally play cards or play chess to take their minds off the game because they knew it was a sucker bet to trade before the Fed days. And I think, one of Kathy's cardinal rules is she does not trade in front of event risk because it's just a sucker bet. Yeah. And I think it's very, very important for new traders to remember this, that on the Fed day, the time to do something is after the Powell speaks, not before, right?
100%. I mean, it's important to know when to trade and when not to trade. And I love trading news. But there's certain events like non-farm payrolls, the Federal Reserve, and the ECB meeting and U.S. inflation data where I will only trade reactively, which is after the number comes out. Now, sometimes I might have a very strong opinion on what I think the central bank will do, and I'll go in proactively before the number comes out. But, this Fed meeting is really a coin toss because there's the move and then there's the guidance. So with this type of event, this has a two-pronged event where we've got the rates decision at 2:00. We've got the press conference at 2:30. We also have the economic projections and the dot plot coming up. The dot plot is going to be very, very important because the market is pricing in rate cuts beginning as early as the end of this year. So everyone's going to be tuning in to those dot plots to see if any of the Federal Reserve officials feel the same way. And so that's going to be very telling. I think that, the opportunity here is, we're going to be live trading with our BK traders. So first thing is, the first 5 minutes after Fed meeting, we're going to see what we get, and we'll look for our first trading opportunity. Then that's probably going to resolve itself fairly quickly before we get into the 15-minute pre-press conference grind. Then, we're going to have to wait till with a speech, we've got to wait till the first couple questions are asked because they're usually the most important. And that's going to give us the real trend move of the day. And then, in Asia, when Asia opens up, there's going to be another beautiful trading opportunity because everyone's going to assess what's happening. So there are 3 opportunities to trade FOMC, none of which this time around is to front run it. All of it requires a little bit of patience, but that's where you get your highest quality trades.
Right. So what do we think Powell's going to say? Do we have any predictions on what on what the angle he's going to take?
He's being very cagey. He's been very, very hawkish, right? Generally, sort of because he's really, really adamant about controlling price levels at this point. They feel like they're behind the curve, and I think he doesn't want to be. He wants to be known as Paul Volcker, not as Arthur Burns, who was a Fed chair during the 1970s when inflation got out of control. On the other hand, Fed's primary function is actually not monetary policy. Is to make sure that the banks are solvent and functioning, and I think that's going to take, precedence. It's going to be, what I love about Powell is he's mastered the art of saying nothing while at the same time, maintaining complete equanimity. So it's going to be hard to gauge. I think my view is conventional, 25 bips. I don't think they're going to surprise either way, meaning 0 or 5. They certainly, if there's a chance that they might go 0, but I don't think they want to do that because I think if they do that, they may think that that's going to freak the markets out even more because they may think that the markets, sort of the idea is that, it's easy monetary policy, they're going to get up. But then the markets could say, oh my God, they must think the bank balance sheets are so horrible that they can't even, raise a 0.25%. Right. It's almost like, you got to keep save face. So I think it's going to be 25 bips, but he's going to be very cagey about, he's going to be say, we're data driven, we're event driven. Don't bother me. No prognosis from me, probably. Right.
I don't even think guidance is very important, but I don't think saying nothing will lead to no price action. I think that the dot plot everyone's just going to tune in to see what the dot plot says. And so, that is probably, if he says nothing, that's going to be everyone's cue on which way to move.
Okay. So what do you think? So that's an interesting question. What do you think the dot plot? Do you think there'll be variance in the dot plot? Do you think they're going to ease up? They're going to first of all, maybe they'll make the terminal rate 5.25 instead of 5.75. Do you think that they're going to project lower inflation in 24, 25? What do you think is going to be the dot plot variance?
Well, it's the Fed funds dot plot that everyone's watching because we know that the Fed's raising interest rates. We know they're probably going to do a little bit more, but are any of the Federal Reserve officials going to skew towards rate cuts and on a longer term time scale, and how long? And that's what we're looking for.
That's what I'm asking.
I think it's possible, and that's what that's really going to drive how everything moves.
So that's a good point. That's what I'm asking. I'm asking
it's not the inflation. It's the Fed funds. It's not the inflation. It's the Fed funds that everyone's going to be focused on.
No. But I was saying the dot plot itself is a projection of all the federal members. It's like the federal members. It's kind of like a polling of what they see the rates as going. And you're saying that it may be that some of the members on the FOMC are actually going to reduce their terminal expectations and actually project maybe lower inflation going forward. That's going to all reflect itself in a dot plot as being more dovish than it has been in the past.
I think what we're going to be looking for is the headline that says X number of Fed presidents now call for a rate cut in blank. And that's going to decide what's going to happen. It's not about, where the terminal rates are. All that is, not as headline worthy. So when they say either 0 central bankers think there'll be rate cuts in blank, that's going to be what everyone latches onto.
Okay. Interesting. Okay. Fair enough. Kay likes to boil it down to the core basics. Yeah.
That's how people need it,
Exactly. Yeah.
So there's a couple stocks to watch. I'll let you guys kind of dive into that a little bit. Kind of talk on a few of the ones that you guys will keep your eyes on into this coming week.
Yeah. So there's, to me, the big stock to watch is Nike reports this week. I think it's Tuesday reports. And the reason why Nike is important, obviously Nike is a component of the Dow 30, but it's also kind of a global consumer stock, right? It had a little bit of internal problems as far as inventory. It's really fixed those problems. Now it's really a question of, is the demand there? Like, is the consumer still spending globally? They're a very well diversified company, obviously. So it'll be interesting to see what they say. If they're still guiding forward and they see the consumer as completely immune to all of these perturbations, is that the word, perturbations, whatever it is, then should be net positive. If they come in very cautious, that could be canary in the coal mine for consumer demand going forward. So to me, that's an interesting thing. The other stock this week that's not an event stock, it's just sort of interesting, is NVIDIA. NVIDIA, of course, has been a huge darling of the semiconductor world because its chips are powered first all the crypto machines, but now they're really focusing on the AI. The GPU chip that they're making is kind of like the primary driver behind all of the AI stuff. And they have a big developer conference this week. So if they're sort of, to me, AI is kind of like the really interesting forward technology that could maybe, rescue us from all of our sins. Because anybody who's played around with ChatGPT, especially the more advanced version, it just, it's today I just nonsense medical stuff. I had my finger hurt. So I asked it and I got better advice and better, analysis, diagnosis than I could from a Harvard, MD. It's amazing, like the level of capacity and knowledge this thing is starting to develop. So I think, that could be the huge productivity gains that we might not be appreciating just yet. And of course, NVIDIA is the manufacturer of the primary chips that drives all the computations behind all that. So it'll be interesting to see, what goes on there. Those are the big stories, I think, this week as far as on a per company level as we go into the markets.
What is the, ChatGPT, what does that do for the trading world? Do you think it affects it at all?
Honestly, listen, easiest thing I can help everybody with is, you're a new trader. Go to ChatGPT and just ask it, I'm a new trader. What kind of advice would you give me? Give me 10 points of advice. And frankly, the first 10 points of advice it's going to give you is some of the best advice you're going to get. I've done this myself. I mean, like 8 or 9 of those things are just cardinal, spot on, and and you should follow. So yes, if nothing else, ChatGPT could give you good advice. But ChatGPT can also write code. I've actually had it write code on NinjaTrader, and the programmers that I work with were like, really? They were like, nah, they couldn't be because it's great. It's by no means perfect. It's never going to be like, out of the box ready. And whenever I see all these videos, I have all these, YouTube videos. I wrote code that made 1,000,000% with my algo in ChatGPT. Yeah. And then when you actually watch the video, you see the guy actually repairing everything. There's no way, unless you actually know what you're doing, that this thing is going to be out of the box perfect. But it's a start, and it's, I think, a very powerful start, and very, very minimum, I would say, it's a great resource tool, just as a sort of a trader. What are the top, what are the best sites to go to? All that kind of stuff. Those are really just foundational stuff. I highly recommend it. It just
helps to short. It's like all of us want things to be efficient. It helps to give us shortcuts, and I think regardless of what you're trying to learn, I think it's a good way and a good start to get advice. And then you got to check it, and that's what we all have to do with everything in life.
Right. Good tool, but not necessarily something to entirely rely on. Say, hey, ChatGPT, take my trades for me. Ty, when I go in that intense.
No, I think the way you want to think about it is, Kathy is absolutely right. On the general stuff, it's excellent. The more specific, the more specialized, the more sort of professional knowledge it is, the harder you need to absolutely check it. Like you can't trust it on you can't say, hey, create a winning algo for me, and then assume that's gonna win for you. It's gonna destroy you. But for basic stuff, just there are many people who are just basic stuff. Teach me what is a pip in Forex? Ask it. It'll tell you much better than 90% of the people. Because it's very patient. That's the beautiful thing about computers. They're very patient. Unlike me.
Very good.
All right.
Asking you guys just kind of on that topic, on the technology topic, what is Tesla looking like? How's the Nas 100 or US 100, looking like, moving forward with this, kind of technology in place? Does it continue to push it, up, or what do you think?
Tesla is it's like religion. You just don't want to argue about it because it's so.
My husband's
so
definitely part of one of the fanatics.
Okay.
But I think, with the Volkswagen new EV car that's underpricing Tesla, I think it's, first of all, EVs, they're not going away. There's just going to be more of them. It's just a persistent trend. But I don't think Tesla's going to be the one with the fastest growth. I mean, they're already slowing. There's a lot of different opportunities. And, it's just a matter of taking a view in the space with a different company that's coming up with new technology at better prices.
Gotcha. All right.
Yeah, I mean, the market, I think we crossed that 5% threshold. I think something like 8% of new cars are all EVs. And that's, once you get to that level, once you get past, then you get past 10%, it just, starts to snowball by itself. So yeah. I mean, it's a better technology in many ways. Absolutely. I'm waiting for my mini.
Of all the, one thing that we really haven't talked about and people really don't have lost sight of is just the persistent layoff announcements in the tech sector. We had a huge burst at the beginning of the year, but we had more from Meta. We had more. Amazon's preparing to fire another 9,000 workers. What are your thoughts on that?
Interesting, because there's kind of two thoughts. There's one, first of all, it's just a drop in a bucket relative to the rest of the economy. These are like 20,000, 30,000. There's like 50 housing and hospitality hire that in a day, right? But hang on a second, sorry. But what I was going to say is it is a concern, because the key question is, will all these people be able to find jobs quickly again? My suspicion is no. And remember, they're all really, really well paid, right? My wife was saying to me that some of the Google engineers were getting paid $500,000 to $600,000 for basically very, I'm like, that's investment banking money,
Something ChatGPT could do, right?
So yeah, and that's actually a very good point. Is that ChatGPT is obviously going to be able to be a very productive tool in that space. So it'll be interesting to see, because that's from a consumer spending point of view. You take away all that income, that could have a serious impact. So we'll see. I think the jury's still out, but certainly a worthwhile red flag, because those are high spending, high income consumers. You take them off the market, you're going to have definitely, contraction in demand. Okay.
From a positive standpoint, this is why everybody needs to become traders, right?
Right, exactly. you have to rely on somebody else for a job. Exactly. Yeah. Exactly.
Well, I know we wanted to dive a little bit into the key. We kind of covered it a bit, into the key levels, obviously, of equities and stuff like that. If you guys want to touch on that, and then if there's any questions, we'll kind of run through those, and then we'll kind of wrap the thing up.
Okay. Well, I want to repeat again. I think to me the key equities is the 38,400 level in the S&P, and that's not going to be resolved until we see Jerome talk on Wednesday. So we have to just sort of suspend our animation. I don't know what I'm sure there are probably some interesting levels you're watching in FX. I know you're watching 107 in euro. What are you watching in FX, Kate?
Well, we're above 107 euro. I mean, 107 is actually not the key level. We were looking at it last week, but the main level to watch is 107.60, which is the high that we have in March. So, monthly highs are very important. If we break above that monthly high, I am very bullish euros. We're going to smooth sail up probably to 108.50. Now, the other pair everyone's always trading is dollar yen. We're below 132. If we hold below 132, we're getting down to 130. So those are the levels that I'm watching. Dollar, yen, euro, dollar, both will be on the move this week. And I think there are plenty of opportunities in currencies.
Yeah, that's great. I mean, the thing I love about dollar yen is what a wonderful trading vehicle it is these days. It's a 150 point range every day. I mean, it's a far cry from the days when dollar yen was trading 75 and we had like a 30 point range for 24 hours. So the better the bigger the range, the better the opportunities, the trades. Yeah.
Now, Kathy, on those two, on like you said, on UJ, on EJ, are those you think it's going to be trending coming into the week, or no? It's still very choppy. You got to be in, you got to be out.
Well, I mean, FOMC is on Wednesday, right? And it's like late day Wednesday. So it's going to be choppiness and, you got to be in and out from now until then. I'm going to be trading with a negative dollar bias from now until then. But, afterwards, it depends, how much we get out of the Fed. What the dot plot says, if there's really clarity, if it's all over the place, that no one is in, and everyone's left, with no clue whatsoever, then it's going to be more choppiness. Okay. So it depends upon how much clarity and guidance they want to give us. And of course, you never know with these news bombs. Another one could drop. So, tread carefully because it's still high volatility markets.
Absolutely. Well, I'm going to check here into the chat here. Let's see. We've got one from Old Fool on YouTube here. First off, a little shout out to Kathy. Said, I'm a big fan of you. I've been following you since 2015. So there you go, Kathy.
You make me feel old.
And then just a kind of a 1B. How do you stay up to date on market news and events that could affect your trades?
I mean, the best way, in my opinion, is Twitter. I mean, Twitter gives you the fastest, news updates, and pretty much to like the half a second that the data is released, you'll get, what is all the important points that are said. So my favorites are Forex Live, investing.com. I think they're, rapid fire fast in terms of getting the news out. My Twitter handle's posted there. I do more, analysis. I don't, tweet the seconds come out because I'm trading. But you can look at who I follow, because usually, those are the people. That's, a good, concise list of what I think are good resources.
Okay, very good. Boris, how about yourself? Any other, resources or any other, sites that you like going to, for your news, or is that typically where you're looking as well?
No, Forex Live is really the best thing in terms of instant news.
Got it.
And then you have a whole bunch of people that, you can look at me also who I follow in terms of, people. And I also have lists. I actually have a list of like a FX list on my website or on my Twitter. Okay. And you can just kind of look at that list and see, what I consider to be, good FX commentary and news sources. But it doesn't have to be complicated. Honestly, I think that's, Twitter can be both a distraction and a tool. I tend to use it much more as a distraction. Kathy tends to use it much more as a tool. So, you could, you literally could set it up in a very, very, I actually think probably what you should do is you should probably create two profiles, one where you just look at it for serious stuff, and then one for you just, engage in Twitter wars all day long.
Right. Is that what you do?
That's what I do, of course. But on the serious stuff, you really just need maybe 4 or 5 columns of very, very curated information, because that's the whole point. You don't want to overwhelm yourself with nonsense, but just very clear, news-driven websites and a couple of, really good people who are very good analysts.
Yeah. If you're not using it already, I highly, highly recommend something like TweetDeck, where you can put your different columns, and because when you have a Twitter feed, it just gets littered with different things, and it moves too fast. When you do TweetDeck, you can focus on the people you want, and then you can add columns for the BS stuff that you follow.
Okay, cool. So we got 2 more here that just came in. Which day of the week do you find the worst to trade on?
I actually think the worst days is midweek for me. Mondays and Fridays tend to be the best. And then, Tuesday, Wednesday, Thursdays tend to be a bit more back and forth, because it makes sense, right? Because for me, I trade flow. In the front of the week and Mondays, it tends to be a lot of flow, a lot of, people positioning for the week continuation. End of the week, there tends to be news flow and, people squaring up. So it works really well for me. Tuesday, Wednesday, Thursdays, you got other stuff going on. It makes it a bit more of a challenge.
How about you, Boris? What do you think?
I will take the opposite side of that. To me, by far, the worst day for me is Friday. Now, that, of course, because I'm trading equities versus FX, and equities tend to have a huge amount of fake outs on Fridays. So you can just get yourself into a meat grinder, and then you're into the close, and it's just you're. So I've learned, basically, I stop all trading 10:30, 11 o'clock Friday. It doesn't matter how good it looks. I leave it. It's it's a rule to live by.
Okay, very nice. And then lastly, guys, and we'll wrap it up. They're asking about, what about Yahoo Finance? Do we like Yahoo Finance? Is that a reliable source?
Yeah. I mean, Yahoo Finance is a legitimate source. It's I would say it's more. stock based. Another site that is very sort of broad based, equity based, I really like a lot is Market Watch. Because first of all, Market Watch it's owned by barons, or they have a very high quality of journalism. These are all it's Wall Street, Market Watch, barons. They're all the same family. So it's a really much higher quality of journalism. If it's honestly, if you have the money and you have the time, you probably want to spend the money on Bloomberg.com. I mean, it's $300 a year, right? I think it's $30. I mean, they just they give you like this sweet deal for like a dollar for the first 3 months, and then they just come in and hit you hard. But I would say there is just no better kind of a deeper analytical website than Bloomberg.com. And the secondary one that's also expensive but also very elegant, really interesting analysis is FT.com. Financial Times. Both of those, if you want to burn money for a year and have just really, really high quality analysis, those are the two that I would recommend.
Okay, very good. Okay. Well, guys, thank you as usual. You guys always come in here and drop some gems on us, give us a lot of good stuff for the upcoming week. Obviously, we will wait till Wednesday to see what happens, and we will obviously be back for our traders therapy, on Friday to really see what happened.
I have just one other thought. Here's the good thing. Because it costs so little money to get a prop account, right? So let's say you have 10,000 of your own money, you're only spending 1,000 on a prop account. You now have all that money to pay for news websites. So that's
there you go. All right. Guys, thank you so much again for taking your time out of this morning. I hope you guys have a blessed Monday, and I will see you